You've tested 5 different strategies in the past year, maybe more. Each one seemed promising when you started. Each one showed potential in the beginning. But then you hit a few losses in a row, and suddenly you weren't sure anymore. Was the strategy broken? Was it the wrong approach for current market conditions? Should you try something else? So you switched. You found a new system. You tested it for a few weeks. Same thing happened. A losing streak, some doubt, another switch, and now you're here. Months or years into trading, and you still don't have a strategy you actually trust. Not because good strategies don't exist, but because you've never given any single approach enough time to prove itself. Here's what you need to understand. The problem isn't that you haven't found the right strategy. The problem is that you don't know how to build trust in a strategy. And until you understand how trust is actually built, you'll keep switching forever, always searching for something that feels certain when trading never offers certainty. Let me start with something most traders don't want to hear. You cannot trust a strategy after 20 trades. You can't trust it after 50 trades. You might not even be able to trust it after 100 trades. And this creates a fundamental problem because most traders expect to know whether something works long before they've gathered enough data to actually know. Think about what you're asking when you test a strategy. You're asking, does this approach have an edge over a large sample of trades across varying market conditions? That's a statistical question. And statistics require sample size. You can't answer a statistical question with a handful of data points, but this is exactly what traders do. They take 20 trades. They win 8, they lose 12. They're down money, and they conclude, this strategy doesn't work. But that conclusion is completely unfounded. 20 trades tells you almost nothing. It doesn't tell you if the strategy has an edge. It doesn't tell you what normal variance looks like for that system. It doesn't even tell you if you're executing it correctly. All it tells you is that you experience one possible outcome out of thousands of possible sequences that could occur with those exact same probabilities. You might have just gotten unlucky, or you might have hit the strategy during market conditions it's not designed for, or you might have made execution errors you have no way of knowing because you don't have enough data. But here's what happens. You don't think about sample size. You think about your account balance, your down money, and that feels like failure. It feels like proof that something is wrong. So you abandon the strategy and move to something new, convinced you're making progress when you're actually just resetting the process. This is the trap. You're expecting confidence before you've earned it. You're expecting trust before you've built it. And that's not how any of this works. Let's talk about what actually happens when you trade a strategy with a real edge. Let's say you have a system with a 60% win rate and a 2-to-1 reward-to-risk ratio. Over a large sample, this is incredibly profitable. Over 500 trades, you'd make excellent money. But what does this look like over 20 trades? It could look like almost anything. You could hit a sequence where you win 14 out of 20. That would feel amazing. You'd think you've figured it out. Or you could hit a sequence where you win only 8 out of 20. That would feel terrible. You'd think the system is broken, but both sequences are completely normal for a 60% system. The variance within 20 trades is enormous. You haven't proven anything either way. All you've done is experience one possible short-term outcome. And here's the part that destroys traders. When they hit that 8 out of 20 sequence, they don't think, this is normal variance for a 60% system. They think, this system doesn't work. And they quit. They abandon a potentially profitable approach because they experience completely normal short-term variance. The cruel irony is that they might quit right before the winning sequence. Maybe trades 21 through 40 would have been phenomenal. Maybe that's where the edge starts to reveal itself. But they'll never know because they gave up at trade 20. This happens constantly. Traders quit right before the breakthrough. Not because the strategy failed, but because they couldn't tolerate the discomfort of normal variance without knowing it was normal. If you've switched strategies in the past few months after a losing streak, comment below, because recognizing this pattern is the first step to breaking it. Now let's talk about why losing streaks feel so devastating. It's not just about the money, though that's part of it. It's about what the losses mean to you psychologically. When you take a trade and it loses, you don't just lose money. You lose a piece of your confidence. You start doubting, not just the trade, but yourself. Your ability to analyze, your judgment, your decision-making. And when you hit 3, 4, 5 losses in a row, that doubt compounds. By the time you're deep in a losing streak, you're not thinking clearly anymore. You're not evaluating the strategy objectively. You're in an emotional state. You're scared. You're frustrated. You're questioning everything. And from that emotional state, switching strategies feels like relief. It feels like you're taking action. It feels like you're solving the problem. But you're not solving anything. You're just avoiding the discomfort. You're escaping the psychological pain of continuing to execute a plan that isn't giving you immediate positive feedback. And that escape, that relief, reinforces the pattern. Next time you hit a losing streak, switching will feel like the solution again. This is why traders get stuck in an endless loop. They're not actually testing strategies. They're escaping discomfort. And every time they switch, they reset the clock. They go back to trade one with a new system, and the whole cycle starts over. The problem is that you're treating emotional discomfort as evidence that the strategy is wrong, but discomfort isn't evidence. Discomfort is just discomfort. It's your emotional reaction to uncertainty and loss, and if you let discomfort dictate your decisions, you'll never stick with anything long enough to know if it works. Here's another thing that prevents traders from trusting their strategy. They don't understand what the strategy is actually supposed to do. They think a good strategy should win most of the time, or at least not lose too often in a row. But that's not how edges work. A strategy with an edge doesn't mean it wins constantly. It means that over a large enough sample, the wins are big enough and frequent enough to overcome the losses. But on any given day, any given week, you might lose. You might lose a lot. That's not a failure of the strategy, that's probability playing out. But traders don't see it that way. They see 3 losses in a row and think something is broken. They don't realize that 3 losses in a row is completely normal, even for a 70% win rate system. The math doesn't feel intuitive. Our brains aren't wired to understand probability. We're wired to see patterns and make quick judgments. And that wiring works against us in trading. So when you hit a losing streak, your brain says, "This isn't working. Time to try something else." And you listen, because that voice feels rational. It feels like you're being smart, being adaptive. But you're not. You're being reactive. You're letting short-term variance override long-term probability. The traders who succeed are the ones who've learned to override that voice. They've learned to think in probabilities instead of outcomes. They've learned that any single trade, or even any sequence of 10 trades, means almost nothing. What matters is the aggregate result over hundreds of executions. But most traders never develop this mindset because they never stick with anything long enough to see the aggregate. They're always operating in the short term, always judging based on recent results, always switching before the sample size becomes meaningful. Let me tell you what trust in a strategy actually looks like. It doesn't feel like certainty. It doesn't feel like confidence that every trade will work. It feels like calm acceptance that some trades will lose, and that's okay because the system works over time. Traders with real trust can take a loss and feel nothing. Not because they don't care about money, but because they know one loss doesn't mean anything. They can hit a losing streak and not panic. Not because they're emotionally detached, but because they've seen enough data to know that losing streaks are part of the process. But you don't get there by finding the perfect strategy. You get there by committing to an imperfect one long enough to accumulate data, to experience variance, to see the edge reveal itself over time. You build trust through repetition, not through searching. And here's the difficult truth. The strategy you're using right now is probably fine. It probably has an edge. It's probably capable of making you money if you execute it consistently over a large sample. But you'll never know, because you're not giving it a chance. You're judging it based on feelings instead of data. This is what most traders miss. They think the problem is external. I need a better strategy. I need a better system. I need something that works more consistently. But the problem is internal. They need to develop the psychological capacity to stick with something through discomfort, to trust a process before seeing results, to commit without certainty. And that's hard. That goes against every instinct. We want proof before we commit. We want to see results before we trust. But in trading, it works the opposite way. You have to commit first. You have to stick with it through the uncomfortable early phase, and then, only after enough repetitions, does the trust emerge. Here's what actually builds trust in a strategy. First, you need data, real data, not 20 trades, not 50. I'm talking about 100 minimum, ideally 200 or more. And that data needs to include your execution, not just backtest results, because you need to know how you perform with this system under real conditions, with real emotional pressure. Second, you need to see variance. You need to experience winning streaks and losing streaks. You need to see what normal drawdown looks like for this approach. You need to feel what it's like to execute the system when it's not working and continue anyway, because that's when you learn whether you can actually stick with it. Third, you need to separate your emotional reaction from the system's performance. Just because something feels bad doesn't mean it's performing badly. Just because you're uncomfortable doesn't mean the strategy is broken. You have to learn to look at the numbers objectively, not through the lens of your recent emotional experience. And fourth, you need to accept imperfection. No strategy wins all the time. No system avoids drawdowns. No approach feels good constantly. If you're waiting for a strategy that always feels comfortable, you're waiting for something that doesn't exist. Trust comes from accepting a system's imperfections and committing anyway. But most traders never do this work. They test for 20 trades, hit some discomfort, and switch. They're always in the early uncomfortable phase of learning a new system, never getting to the phase where trust actually develops. If you want content that focuses on the psychological work that actually matters in trading, subscribe to this channel. Because we don't sell quick fixes or perfect systems. We talk about the internal work that separates traders who make it from those who stay stuck. Let me give you a concrete example. I spent the first year of my trading trying 7 different strategies. Each one seemed good initially. Each one stopped working after a few weeks. At least that's what I thought. What was actually happening is I was hitting normal variance and interpreting it as system failure. Then I made a decision. I picked one approach, nothing fancy. A simple momentum breakout system, and I committed to trading it for 6 months without switching, no matter what, even if I lost money, even if it felt wrong. 6 months, minimum 200 trades, no changes to the core rules. The first month was brutal. I lost money. I wanted to quit so badly. Every part of me was screaming that this wasn't working, but I had made a commitment, so I stayed. Month 2, I was break even. Month 3, small profit. Month 4, back to break even. By this point, I had about 150 trades, and something interesting started happening. I began to see patterns, not in the market, but in my execution. I started noticing which setups worked better, which conditions favored the system, when to be more selective, and when to be more aggressive. By month 6, I had over 200 trades, and I was consistently profitable. Not because the system magically started working, but because I had finally accumulated enough data to understand it, to trust it, to execute it with confidence. And here's what's critical. The system I used wasn't special. It was basic, probably the same type of approach I had abandoned 3 times in that first year when I was strategy hopping. The difference wasn't the system. The difference was my commitment to it. So here's what I want you to understand. The strategy you're using right now is probably capable of making you money. But you're never going to know if you keep switching every time you hit discomfort. You need to make a decision. Pick one approach. It doesn't have to be perfect. It just has to have a logical edge. And then commit. Not for 20 trades, not until you hit a losing streak. Commit for a specific number of trades or a specific time period. 100 trades minimum, 6 months minimum. During that commitment, you're going to want to quit. You're going to hit losing streaks, you're going to see other traders posting wins with different systems, you're going to doubt everything. That's normal. That's part of the process. The question is, can you continue anyway? Because trust isn't something you find, it's something you build. And you build it through repetition, through experiencing variance and continuing to execute, through accumulating data until the edge becomes visible. Through proving to yourself that you can stick with something even when it's uncomfortable. Most traders never build this trust because they're always searching for it in the next system. They think if they just find the right strategy, trust will come naturally. But it doesn't work that way. Any strategy requires commitment before trust emerges. Any approach requires you to push through doubt before confidence appears. The traders who make it aren't the ones who found the perfect system. They're the ones who committed to an imperfect system long enough to make it work. They're the ones who developed trust through data, not through feelings. They're the ones who understood that switching is easy and staying is hard, and they chose hard. Here's your challenge. If you're currently using a strategy, commit to it for the next 100 trades. No switching, no major modifications, just execution and data collection. Track every trade. Journal your emotional state. Note market conditions. Build a real database. After 100 trades, then you can evaluate. Then you have enough information to make a real decision. But not before, because anything before that is just guessing based on variance and emotion. And if you're between strategies right now, pick one. It doesn't have to be the best, it just has to be logical. Then make the same commitment, 100 trades, no switching. Build the data, build the trust, build the skill. This is how you escape the strategy hopping trap. Not by finding something better, but by committing to something good enough and giving it the time it needs to prove itself. You can't trust what you haven't tested thoroughly. You can't be confident in something you've only done 20 times. Trust comes from repetition. Confidence comes from data. And both require you to stop searching and start committing. The perfect strategy doesn't exist, but a profitable strategy executed with discipline over a large sample absolutely does. The question is, are you willing to commit long enough to find out if what you have is already good enough? Most traders aren't. They keep searching, they keep switching, they stay stuck. But you don't have to. You can make a different choice. You can commit. You can build trust through action instead of searching for it in theory. And when you do, when you finally stick with something long enough to see the edge emerge, everything changes. Not because the strategy was magical, but because you finally developed the one thing every trader needs, the ability to trust a process without needing constant validation. This is Trader's Mental Edge, where trading starts in the mind.